Hello, everyone. Today on the final bar, we do our Monday routine, hitting the market from three directions: top-down macro, sector rotation, bottom-up stock picking. Today's further upside, to be honest with you, follow-through led by the mega cap stocks like Apple, Microsoft, others really driving the market higher. Mega cap driven, but mid caps and small caps participating as well. We talked about the unsustainability of stocks, bonds, and gold all going up together. Stocks sort of emerging today in the position of strength. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the action, get through the flickering ticks of the trading day, focus on the trends, and connect the short-term movements of today with the long-term trends and how they evolve. It's so important now with so much, with plenty of volatility, with lots of news flow, lots of earnings, lots of macro tailwinds and headwinds. Focus on the long-term trends in general. If you lean into the trends that are working, lean away from the trends that are not working. Overall, I think you're going to go through this process pretty well. It's been all about leadership, and it's been about the resilience of this uptrend. And again, if today is any indication, we continue to see strength driven by technology, driven by healthcare, but that mega cap tech trade alive and well with stocks like Apple gapping higher, following through on Friday's strength as well. We have some fantastic guests coming up. Last week, I was really excited, guys like Larry Berman and others that joined the show. This week, we have three fantastic guests for you. Tomorrow, on Tuesday, the 4th, we have Andrew Thrasher from Thrasher Analytics. On Wednesday, Gary Dean from sentimenttiming.com. And on Thursday, Julius DeKempener, founder of RRG Research and creator of the RRG methodology, giving us a little sector view. Earlier today, we premiered our latest episode of Behind the Charts. That's our interview style show. We sat down with Al Brooks, who's a licensed MD, he's a medical doctor, and him, Joe Duarte, others. There's this whole pattern of medical doctors going into the financial markets and finding success. Al had a great conversation about how he learned to day trade during the '87 crash, which was a really interesting look into trading psychology, the importance of discipline and decision making. So it was a really good episode. If you missed it, check it out on our YouTube channel. You can check all the previous Behind the Charts episodes. I want to get down to the market recap today. I want to start with a poll, actually. So we have polls running all the time on StockCharts TV on our main page and other venues where you see our content. Often you'll see a poll. I'd love for you to participate as much as you can. It just allows us to have a good dialogue about what you as a group are seeing and gives us some things to discuss on the show. Recently, we asked you, are you changing your overall allocation to equities this week? And we asked this going into the weekend last week. And here are the responses. Over half of you, 57%, keeping your equity allocation about the same. 26% decreasing your equity allocation. 17%, the smallest number, increasing your equity allocation. So, there's a lot of ways you can sort of draw conclusions from this. I think this is what I would say. Number one, what this tells me is if over half of everyone are keeping their equity allocation the same, very few of you increasing your equity allocation, it feels like the buyers are there. I feel like those of us that are there are pretty much, in or are starting to add a little bit. Only 26% trying to sell on strength, betting on some potential downside. I don't know what number I would feel good about or not good about for each of those, but it certainly made me think about how I'm approaching an overall equity allocation at this point. And, for me as a trend follower, I often just come back to, the long-term chart of the S&P 500. And if the S&P is going up and to the right, in general, I'm going to want to own stocks. And again, I don't know if I've seen anything in the last little bit that would suggest to me to materially increase whatever I've had into equities. Because I think at this point, hopefully you're there and you've recognized the strength led by the mega cap tech names and consumer names, communication services names, and you've identified those uptrends that we've been talking about for a while. What concerns me is increasing it here because it's all about a risk reward, right? Looking at the chart of the S&P, this is the spiders here. If you think about S&P 3400, or this is around, 335, 340 on the spiders, that's about, that's sort of the long-term resistance. I don't know if I would expect being materially higher than that by year end without some sort of pullback of sorts, but I certainly could be wrong. So interesting to see your allocations, and again, I'd encourage you to think about the long-term trends, how they evolve as you're making that sort of decision. Let's look at the remainder of just what's happened today, try to make sense of things. So the S&P closing just below 3,300. It peaked above it in the early afternoon, but finishing up just over 0.7% to 3295 or so. Mid caps and small caps up even more, with the small cap index up 1.25%. The only major index down today was the Toronto Stock Exchange. Pretty much all the U.S.-based markets higher. The NASDAQ 100 certainly dominated by technology. Tech was the number one sector. NASDAQ 100 outperformed the S&P today. Looking quickly at some of the other asset classes, we've talked about this unsustainability, what I would describe as stocks, bonds, and gold all going up. And again, can that happen? Of course it can. And there are times when they are highly correlated positively, when they're highly negatively correlated, depending on the conditions and all the different macro factors that are input. But when I see all of those going in one direction, that seems very unsustainable. One of those has to give. It's a game of chicken. You wonder what's going to break. Based on today, you saw bonds come off out of the open while stocks remain strong. If you look at gold, finished just net positive, but really open in a position of weakness. So all of them, sort of sideways to up, with stocks certainly leading the way higher. In terms of sectors, again, it's dominated by the mega cap tech trade. And again, the chart of Microsoft, Apple maybe is a better one, just showing you this, reaffirmation of the dominance of mega cap tech. And all along this way, we're talking about, can the market, is that sustainable of an uptrend driven by a small number of mega cap names? The answer is it's sustainable way longer than you might expect. And I would worry less about unsustainability based on that leadership and more on the trends themselves and where they're evolving. And when Apple does what it's done over the last, 2 trading days, that suggests to you that there's upside potential. There's further upside potential until that pattern of higher highs and higher lows changes. It's in a pretty decent uptrend. We're going to get more to stocks in a little bit, so I don't want to completely overwhelm it. But it's worth noting this is basically offense over defense when you think about today's trading day. So where does this leave us with the S&P 500? So, again, very simplistically, I wrote an article for the SAMT, the Swiss Association of Market Technicians, or it's something kind of like that. I don't know if that's the right acronym, but it's definitely SAMT. It's the Swiss Technical Analysis Society. And I wrote an article for them just recently talking about my technical checklist and how you prepare for a trade by listing out your technical inputs and identifying whether they're each bullish or bearish. And that's the way you develop the weight of the evidence using technical analysis. And step 1 is Dow theory, which is the chart going up or down, defined by Charles Dow's methodology of higher highs and higher lows are an uptrend, lower highs and lower lows are a downtrend. By any measure, the S&P is in an uptrend. It continued to validate that today with a new closing high, a new swing high above mid-July. As I mentioned to you before, if we break above the June highs and confirm it, which I think we've now done, I have to assume the S&P is going to 3,400, if not higher, and I'll look for that. That's sort of the next objective I would be looking for. I think fairly reasonable to expect that we're gonna get up there. At which point I'd reevaluate it. The way I would decide that thesis is wrong is we start to make a lower low and a lower high. We're not there yet. Uptrend is still in pretty good shape here. Just to finish off our recap here, I wanted to look at some of the themes underlying the macro trends. We've talked about breadth, which again is very much leaning towards the mega cap trade, but again within industries, within sector and group themes, there are plenty of movements to be aware of. We talked about healthcare last week. In particular, we're looking at some of the non-big pharma trades, things like medical supplies, medical equipment, and so forth. Interesting to see medical supplies in the top 10 list. Aluminum stocks within materials were one of the top 10 as well. Also steel. Software, which is a group with some names you're going to know, like Microsoft, up in one of the top 10 as well. Automobiles, this is Tesla's group, up 3.4%, coming off a bit of a pullback as well. Also interesting to see drug retailers, computer hardware, that's Apple's group, in the top 10 as well. So again, these are some big names you're probably very familiar with. continuing that mega cap theme to the upside. Our next segment, look, now we've talked about sort of the macro conditions, where they're at. Again, very supportive of continued upside, I think, overall. Let's look at sector setups. Let's focus on the sector rotation and what we can draw from this. We're going to start with the RRG chart, the relative rotation graph. As I mentioned, Julius de Kempener is coming on the show on Thursday. If you're not familiar with this, check out his videos on our YouTube channel. He hosts a show called Sector Spotlight. Does a good job of demonstrating this methodology. But basically, it's looking at the 11 S&P sectors, how we're rotating around the S&P there in the middle. And to orient you, what has been happening is technology for a while has been the strongest sector, and that's because it's furthest to the right. Forget about the direction of the arrows or the direction of the path of each of these points. Just look at the furthest to the right, furthest to the left. That gives you the relative strength to relative weakness based on a pure, essentially a pure relative strength read. The fact that it's gone sort of southwest and heading into the weakening quadrant shows you that there's rotation. The momentum is subsiding a little bit. You can see that it's actually round tripped a little, or made a 180 of sorts. You can see how it went into the positive, the leading quadrant, now turned around, goes into the lagging quadrant, and then just this last week uptick just a little bit. And I would assume that's going to continue this week. Again, assuming this continuation of the mega cap tech strength that we've seen with Microsoft, Apple, and other semiconductor names and others. So I wouldn't be surprised if we see this rotate back into the leading quadrant yet again. And so I think with technology, we're going to look at the individual chart in a while, but until proven otherwise, a sector that keeps going up and to the right, a sector that keeps outperforming, I'm going to assume that continues to happen until the trend changes. Interesting to see communication services, consumer discretionary, materials all rotating lower. So that's telling you the momentum's rolling off a little bit, but overall they're still outperforming. And I think this is the nature of this rotation that we've felt over the last 6 to 8 weeks. There's this period where it felt like things were rotating away from the mega cap, the sort of the FANG trade, into other places. And I think that sort of reverted back into the continuation of the previous leadership themes that we saw. Sectors like financials, XLF, sectors like industrials, XLI, starting to come over to the right. And one of our mindful 6 stocks is Morgan Stanley. We're going to look at that in a little bit, and you'll see that it's actually holding up very, very nicely. So there are some charts within financials that are actually holding up, but as a sector, still underperforming pretty well. Energy is, again, from a technical perspective, I think you'd be hard-pressed to be looking at energy stocks on the long side from a purely technical perspective until you see better accumulation in some of those charts, which we haven't seen yet. Interesting to see healthcare has rotated now into the lagging quadrant, which, again, these are telling you the cap-weighted picture of the entire sector. I would say with things like medical supplies, we talked about healthcare providers, medical equipment, there's some decent charts within healthcare, but again, when you look at the effect of some of the big pharma charts, it's holding these back, and some biotech as well that's come off a little bit. Finally, we have the defensive trade that is, sort of still underperforming, but coming up a little bit. Sectors like utilities and real estate really have to, I think, prove themselves by breaking above the 200-day moving averages, by emerging on a relative strength basis. I saw signs of that with utilities last week. I don't know if we're seeing enough of a continuation of that. It's all about the follow through after a break above the 200-day. We're going to look at the individual charts here, and we'll talk about those as well. So you can see sort of these buckets, sort of these leadership themes that have been working over here: tech, consumer discretionary, communication services, materials, the gold stock trade that's been very, very strong as well. Rotating down, but again, things like technology reverting back to the upside, and I think you might be seeing a bit of a little internal rotation with each of these sectors as we digest this rotation in leadership here. Let's look now at the candle glance page. So this is now looking at all 11 S&P sectors along with the S&P 500, looking at what themes we can tease out here. Which sectors are above ascending moving averages? And there's a handful of them now. Communication services, check. Consumer discretionary, check. Consumer staples, check. Healthcare, positive. Technology, positive. Materials, positive. So that's not bad. I mean, that's a pretty decent. That's how over half the sectors that are in that configuration above 2 upward sloping moving averages. It has not been that rosy of a picture looking across the board, but those names that I mentioned are the ones in the upper right quadrant for the most part of the RRG, and that recognizes the outperformance that comes with being in an uptrend, to be honest with you. In terms of things that are below two downward sloping moving averages, not many actually. It's only energy, and that's when I talk about the relative weakness in energy. We can bring up the chart, and you can look at the relative strength, which has been suffering. And again, this is where energy felt like it might start to work. This is in May to early June, leading up to that June high. It certainly felt like it, and energy, don't get me wrong, was in a pretty decent uptrend. But since then, it's been lower highs. So far, it potentially is a higher low. We'll have to see if it remains above 34 on the XLE. That's the support from May and from July. But overall, below two downward sloping moving averages. And in general, that's not where I look for ideas for the long side. You want things that are more in an established uptrend. So not enough stability, I think, on a technical basis there. Then you have those things that are sort of in the middle, and it's stuff like financials between the two moving averages, industrials, utilities, real estate, all testing the 200-day moving average from below. Here's a chart of industrials, so testing from below. And again, within industrials, it's a mishmash of things. You've got things like Boeing, you have airlines, which have looked pretty heavy, pretty negative, but others as well, sort of all mixing together into that sector. Utilities, I actually wrote about on my blog, I want to say last weekend. It's a bit of a blur, but I think I wrote it somewhere. We were talking about it, testing the 200-day moving average. And again, we're entering this resistance range. So some of these defensive sectors, okay, they're not horrible. But when you look on a relative basis, it's now sort of pulling back a little bit until this relative strength improves. And so you get enough of a rotation and holding above a 200-day moving average instead of just trading above it. I think you have to stick with the more offensive trade that has been working. And as I promised, let's finish with the chart of technology. For me, I think this is the benchmark by which others have to be measured. This is a sector that's going up and to the right. It's gapped higher again. The relative strength has made new highs. That's what uptrends are made of. And again, as long as that continues until proven otherwise, I think you have to assume that the path of least resistance is higher. We need to take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we'd love to get your questions and your feedback, particularly your questions, because tomorrow we'll do another mailbag segment. We've gotten some really good questions over the weekend. We'd love to hear from you. If we can answer your question on the air, it would certainly be a pleasure to do so. Two ways to get your questions and your feedback to us. Number one, via email at thefinalbar@stockcharts.com. Number two, just tag us on a Twitter comment at FinalBarSCTV. Again, we'd love to hear from you, and we'll do another mailbag segment tomorrow. One question I did want to answer, because it came over the weekend, and it's very timely with what I saw here. Someone made a comment about the island reversals, and hearing a lot of comments about potential for island reversals. And if you're not familiar, the island reversal, probably easiest to see on the S&P 500 chart. This is back here where people were talking about it, and that's where you have an uptrend. You have a gap higher, which creates this sort of island, these bars, away from the others. But I would say it's really not confirmed until you have the completed island, right? Until you have the other part of it, the gap down that is in that same range. And then you literally have sort of this island of price data floating off on its own. In general, that tends to be a negative signal because you gapped higher, something caused a revaluation to a new level, but then you gapped lower, which basically meant it was rejected. That breakout was rejected and the gap higher was rejected, and we've gone back down. That led to this sort of sideways consolidation trend in June. In the end, obviously, as you know, it did resolve to the upside. But, so can you call this an island reversal? So technically, no, because so far it's just an uptrend. It's a gap and an uptrend. If the price continues higher and we never get down near these levels, it's nothing like an island. So it's a common mistake, I think, to preemptively consider something an island reversal before the islands actually happen. Right now, it's just a gap. If we would gap back down. So if, the XOK chops around here for a couple of days and then Thursday or Friday, we gap down to 110. Yes, we could call that an island reversal. Yes, in general, it tends to be negative. It tends to be a bearish signal. And I will absolutely spend some airtime talking about that and what it means. But at this point, it's a bit premature. Now it's just a gap and you could argue sort of a continuation gap, sort of continuing this this uptrend. I would say. Having said that, let's get to our next segment called Shifting Stocks. So the idea here is to focus, now that we've looked at the big picture, looking at the macro themes, looking at sector setups, let's now focus on individual stocks. Part of my routine is looking at the S&P 500 names over the weekend. Today I want to do something a little bit different, though. I wanted to revisit the Mindful Six. We talked about this a couple months ago, sort of created this idea around the June highs of let's look at a basket of, started as 3 names, added another 3, called it the Mindful Six, and said, let's see how these 6 stocks do relative to key support and key resistance. One of 2 things is going to happen, or I guess one of 3 things. Number 1, it breaks above its June high, like the S&P has now done, sort of continuing the uptrend. Option 2, they all had a pullback right after the June high, so they break down through that support level and suggest a new downtrend. Or option 3, they remain range bound. And to summarize, 2 of the 6 have broken to new highs, have continued a pattern of higher highs and higher lows. 4 of the 6, the remainder, are all neutral, sort of stuck between resistance and support. Let's look through each one of these, and I think that'll help us sort of think about some of the broader individual stock themes we can tease out. So the S&P is at the top, and then I'm just showing each of these 6. We'll go through them one at a time. This is applied materials, so within technology, you can see this is one of the 6 that has broken above its June high, which is back here. So we've continued this really simplistic pattern of higher highs and higher lows, breaking a new closing high since the March low today. Just for that period. Back above 65 now for the first time since last February. So again, it's now testing that all-time high here, the long-term high in mid-February, the peak before the sell-off. So overall, chart number 1 in an uptrend, that's applied materials. Morgan Stanley is the second chart that's done so. Now, this actually broke higher the second week in July. Since then, it's pulled back a little bit, and now it appears to be having essentially a buyable dip within this uptrend. It's interesting in a sector like financials, which I think a lot of people have written off, myself included, just because the average chart doesn't look so good. There are charts like Morgan Stanley that actually are maintaining this uptrend, higher highs, higher lows, and it checks the box, breaking to new swing highs. The rest of these are still in no man's land, sort of unable to break above the June high, unable to break below support after the June high, so it's sort of still in wait and see mode. So first we have Starbucks here in the middle, and again, what concerns me is this, with the peaks surrounded by lower peaks, it's almost like a complex head and shoulders pattern, which is a head and multiple shoulders on both sides. We're kind of getting that. That isn't validated until you break down below the swing low. So a break below 70 really on a closing basis would suggest really much further downside for Starbucks, but not there yet. At this point, it's sort of stuck between support and the 50-day moving average. Cisco is next, and this is stuck between resistance right at 48, support right around 43.50 or so. And again, if it breaks above 48, that would certainly suggest a nice continuation of the uptrend. Has not been able to do it yet. Nike stuck within this range, really consolidating right around $100, which is a very key psychological level. And all of a sudden, when you look at the longer term chart of Nike, you get this sense of a stock that has, a number of times now tried to break above 100, has been rejected each time, usually getting up to around 105 or so. So, that's sort of your upside resistance. That would be a new significant high for Nike if it's able to do so. Disney is the only one that has already broken below support, but it rejected that. It didn't follow through. We've talked a lot about a breakdown and then a follow through, right? You close below it, then you want to move lower, and it basically did not happen. You didn't get the confirmation of a downside breakout, and at this point, you're once again stuck in a range between maybe 109, 110 on the downside and 125, which is also the 200-day moving average there on the upside. So, overall, 4 of those 6 sort of stuck in the middle. 2 of them have confirmed upside or in more of an uptrend. So overall, sort of neutral, leaning positive. What's interesting though is that the S&P, out of all those charts, maybe applied materials is the most technically attractive. With a nice consistent uptrend, the S&P sort of chopped around a little bit, but overall, obviously in a pretty good uptrend there. The last thing I want to look at just in our segment on shifting stocks, and sorry, I always wish we could spend so much more time on individual names, but we'll do the best we can. I just want to highlight some of the stocks in the upper list, right? So the Scooter reports tell you which stocks are the strongest charts out there based on a simplistic technical model. You can look on our chart school pages, and we list out exactly what's causing stocks to be ranked in the top there. What I'm going to do is go to Scooter Reports, and this is looking at the large cap universe, and it's sorting it in order. So this is a great way to look at what sectors are represented in the top 10. What caught my eye as I was looking at this over the weekend is that 5 of the top 10 stocks are within healthcare, which is actually a bit of a surprise. I would expect technology to be the overweight in the top 10. And don't get me wrong, 3 of the next 5 are in technology. So don't get me wrong, they're represented there. But in the top 10, it's ABMD, it's West Pharmaceutical Services, Regeneron, and Varian that are all going at the top here. Now, some of these are a little gappy, right? This is maybe the most consistent uptrend. This is West Pharmaceutical Services, WST, which is in medical supplies, 20 billion market cap. So it's a little smaller than other names we talked about, sort of coming out of the mid cap space. But the relative strength has been really positive. This is a chart that's extremely overbought, which in general usually means a bit of a pullback before resumption of the uptrend. So it's up 3.6% today. Pretty decent, consistent uptrend. Dexcom has been one of the top 10 stocks, if not the number 1 stock for a while. It's come off a little bit with Tesla and others taking their place. This actually looks a little more base-like, right? Where you have the resistance here in May, sort of tested that, now testing a breakout. But I love the fact that it's pulled back to the 50-day a number of times, keeps rotating higher, and the RSI never really overbought. It's sort of this nice, steady uptrend, which is unlike what we're used to. We're used to stocks going vertical in this sort of configuration. This is actually a rare situation where it has not happened. Let's finish with Tesla again. I like to focus on a name that we're all probably following very closely. So, Tesla is a fascinating chart. I bucket it with Bitcoin in terms of, really capturing the euphoria, the fear and greed that you might attribute to the Robin Hood mentality. A lot of, arguably uninformed, but certainly inexperienced investors getting into trading and adding volatility, I would hope, but certainly following trends very quickly. You can see Tesla has really come off. And what's interesting about the chart, forget about the fact that the long-term trend has been positive, the relative strength has been solid. I totally agree. What concerns me about the long-term picture of Tesla is just the signal in the last couple times it's broken to new swing highs. The next day has been a pretty solid down day. The last one you had was this bearish engulfing pattern about a week and a half ago, 2 weeks ago. And so, it's been unable to really move materially higher than this. Again, 1800 is a pretty good clip. It's a 20+% move from where we're at. So these are big percent swings, but overall, we may be getting to that point where buyers are exhausted, where sellers are coming in and pushing the price a little bit lower. But I'd love to see some more of a bullish, configuration, really with the candlesticks telling you that there's some accumulation happening. Today, more of an inside day to the upside. That's our segment, Shifting Stocks. We need to wrap the show and go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is India. We didn't talk a lot about global markets today, but the weakness in the dollar has certainly, I think, brought it more front and center for a lot of investors for good reason. What's interesting about a chart of India, and here we're using the INDA, which I find is a way a lot of investors in the US, a lot of advisors get exposure to something like India. If you look at the log scale chart, connect the low from March with the low that we had in June, which is a real simplistic trend line analysis. We're right there. We've pulled right back to that trend line. So that means one of 2 things. Number 1, coming off this overbought region, this is a buyable pullback. The uptrend continues. If we break down through that trend line support, if we follow through and break down through the 200-day moving average, I'd be more concerned about potential downside. I've highlighted some Fibonacci levels I think could be of interest, but overall, I'd be concerned if we break down through this trend line. It's at a really interesting time right at the moment. Chart number 2 is the VIX. Again, it feels like things are volatile, and overall, compared to the average volatility for the last 6 to 8 years, it is. But what's interesting is we've come off a lot, right? So the VIX is back now below 25, right around the 25 level. This is looking more and more similar to what we saw here after the 2008 to 2009 sell-off, where the volatility spiked into the 80s, came back down. You had a couple upswings, which we've also had, but it's slowly and steadily decreased as an uptrend sort of settled back in 2010 to 2011. I'm not going to guarantee that's what's happening, but I will certainly be watching the VIX to see how it compares to that other historical parallel. And then the final chart for today is looking within healthcare. We talked about some of the healthcare names in the top 10 of our Scooter rankings. This is Pfizer, and I think when you unadjust the prices, we're potentially making a new swing high, testing that 200-day moving average from below. I'd be very interested to see if Pfizer can overtake the 200-day, continue this uptrend. That's our show, folks. Thank you so much for joining us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.